Welcome to Subramani. Yesterday, that is 8th of February, the Reserve Bank of India came out with its interest rate hike of 0.25%, which was in line with expectation, and people thought that this is perhaps the last, or people do think that this is one of the last rises, if not the last rise, right? Can the interest rates go up further? I'm not guessing, but if the war escalates, can you imagine February 2022? Did we expect the war to last for one whole year? No. If the oil prices go up too high, the world cannot afford it, but chances are if the market, if the oil prices go too high, or some such extraordinary event happens, maybe interest rates will go up. Otherwise, it looks like the last leg of the interest rate hike. At 6.5% repo rate, we have one of the highest interest in terms of real interest, because our inflation admittedly is 5.7%. So we are getting a very high real rate. Now, for heaven's sake, when somebody tells you we were getting 12% in PPF long back, all those uncles and aunties, including people like me, you have to tell them, uncle, what you were getting was a nominal rate. What we are looking at is real rate. Real rate means 6.5 minus 5.7, you're getting 0.8% real interest rates, which I think is a good time to be locking in on long-term funds, right? Wherever you're getting long-term good rates of interest, you should lock in. Whether it is HDFC as a fund, which is 2055 maturity, they call it the long debt fund. Then there is the Nivesh Laksh, which is actually cheaper than the HDFC fund at 0.15% on the direct basis. These are some of the places where you can lock in, or you have some of the insurance plans which also look attractive as of now, because from 1st April it's going to get to be more taxable. So good time to be locking in on rates which are good for the long run, right? Having said that, if the Fed were to increase interest rates, would India increase interest rates? I do not know, because US is still on a negative real rate, right? We are getting a positive rate in India, it is a negative rate in the US. So will US keep increasing interest rates? They have to. Will India follow? Maybe, maybe not. Let's see, because I do think increasing interest rate will start hurting growth. So I don't think interest rates are going up in a hurry. Even if it were to go up, it will go up maybe 0.25, but even that India has a good control over its fiscal deficit. The GST and personal income tax and corporate tax rates are going up well. The government has already invested a lot in infrastructure. During COVID, they played a very smart card by investing in infrastructure rather than giving out doles. So all this augur well for inflation to be lower than even the targeted 5.4. So if you can lock in your money today at 7 plus, and the targeted interest rate, targeted inflation is 5.4, chances are you will make some capital gain also on your portfolio. So what should be your strategy now for investing? As I said, you should be locking in on long-term gain, 2-3 funds which I named also. Keep your money in let's say you got 20 lakhs to invest in debt funds. This I'm assuming for a family where they already have exhausted their PPF. PPF still is my first place to go for investing for debt fund, or the Sukanya scheme if you have a daughter. After that, when you have money, you should keep some money in floating rate fund and some money in these long bond funds which are 20-year maturity and 30-year maturity. Take some guts, because if any adverse interest rates could hurt you, but we are at the peak, and well, almost at the peak or very near the peak, so you don't have to worry too much about that. So what would I do? I would put in a long bond fund like Nivesh Laksh or HDFC 2055 maturity. Some money I would keep in a floating rate fund, waiting for some indication that this should be the last one, because any rate hike more than this would hurt growth. So if in oil prices were to go up, the government would be scared, but I still don't know whether they would have the guts to increase interest rates, because it's going to hurt the industry. It's going to hurt your real estate. People will not be able to afford houses, or housing will become even more expensive, right? So interest is a big element of the cost of your acquisition of a house. EMIs will go up. Your 10-year EMIs will become 12-year, and your 12 years will become 15 years, and your 15 years will become 20 years. That's not something which people want to see. So I don't know whether interest rates politically also can go up, at least not till the elections of 2024. So those are all in your favor. And the financial condition, only thing is the financial conditions because of which the amount of money that is required by industry, there seems to be a gap. Naren says the gap would be something like 5 lakh crores. That could put pressure on interest rates, but maybe there would be bonds which are issued, by industry, and if more and more money comes to mutual funds, then mutual funds would try to meet that gap. So that is one reason why interest rates can go up, but it looks very difficult for interest rates to go up much further. I personally am locking in my money. I already invested in some of the long bond funds, and I think that's the way to go. Good policy. If interest rates go up, I mean, if oil prices go up, if the war escalates, if Fed keeps on increasing rates, which it might, we don't know what the Fed is going to do. But if growth gets impacted in US, the US will also not likely to US is also not likely to increase interest rates. So some of these, it's a little iffy, but I would put at least 70% of my long-term committed money which I don't require for 10-15 years, into the long bond fund. 70%, 80% maybe. I do think that last 2 months, 6 months, I've been accumulating money in a long bond fund, but I do think I take some hit in my portfolio. So I would think you should do an SIP into a floating rate fund permanently, or into a ultra short bond fund whenever tactically you need to move into such schemes. For example, if you're moved into the scheme and the scheme is giving 8%, just assumption, after that you stop accumulating money in that long bond fund. You wait for the capital gains to kick in, which could be when interest rates go down to maybe 5%. You will have a lot of capital gains kicking in. Take a lot of money out and put it back into your floating rate fund, and wait there for the for investing in a gilt fund again when the cycle is down. So these long bond funds are good funds to accumulate money when interest rate is moving from, say, 7 to 8. I'm assuming permanently it will be 7 to 8, and after, when it touches 8, you come back, you take the money out when the interest rate falls to, say, 5%, which means you have booked in all your capital gains. You take a big portion out and put it into a floating rate fund, and then again you wait for the cycle. So you have to play the cycle. It's like a thematic fund where you don't just do an SIP. Tactically you move in and out by being in the floating rate fund or an ultra short bond fund. That's what I do. That's what I like. Whatever you do, this would be my strategy going forward, because I think interest rates have peaked in India, but we're still getting a good 0.8% real rate. Enjoy it. You won't get it too long, right? Thank you.